Good morning, everyone. February 7th, 2016, Super Bowl Sunday. Happy Sunday, everybody. I hope that you will enjoy the game today. Some people asked me, wrote me some messages in light of the collapse of the energy sector. Is there any other sector within, say, the S&P 500 or the economy that really looks overripe for a fall? And I guess I would have to point to, well, I've talked about retailing quite a bit and how retailing's greatest days are behind it, at least on a bricks and mortar level. It's not the event thing that it used to be. Let's hang out at the mall. It seems so 80s and 90s. Let's go to the mall. And I mean, I go to the mall these days, and they're struggling with closures coming soon. A new Simon, business will occupy this space. Well, a year later, they're still not occupied because you just don't have the foot traffic. You don't have the ability to price your product to compete with online things. So that's a sector that still hasn't come to grips with the reality of the situation, the changed fortunes of real estate and everything moving to, well, the efficiency of the online world. Now, people aren't going to want to buy clothes. Well, they do online, but it's not perfect in that way. But people will shop tags and then go home and buy it online. They use the stores to see the merchandise and then they go home and put it in. Why do you think so many department stores have blocking software for cell phones and things? Because they don't want you to do those price shopping comparisons. But I want to talk about the tech sector today, and particularly the social networking side, because it's another sector of the society, and Google to a large part is involved in this too. Although search is a very powerful and useful feature, it's like it's over grand within the scheme of pricing and all that. And you look at things like Facebook, which are very taste driven from, say, generation to generation, and we all know something new will come along. MySpace was pushed out, and Facebook came in, and soon there'll be other things on the horizon that we don't know about. But the whole tech sector has just been destroyed with like a 25% drop in value. And that's the backbone of a lot of things, particularly out in California here and in some parts of Texas and the South, Silicon Valley, and all the wealth spinning out of there, the Intels, up in Seattle, the Microsoft. It's all like getting a really severe haircut in terms of market values right now, and with the end result that it's signifying something's coming to the real economy here. And what's coming is probably a dose and a smack of reality. San Francisco remains behind New York, or tied with New York, as the most expensive city to live in America. Well, because there's so much wealth generated there, just like in New York City with all the funds and all the managers, all the Wall Street traders, all the mutual funds, all that activity is a channel for trillions of dollars to move in and out. Well, the Bay Area here in San Francisco is the same way. It's been a money spinner. And when you have below ground 1-bedroom dumps that have never been renovated, that are still using the same appliances that went in 1959, when the last renovation was done, in buildings that were built in the after the San Francisco earthquake in 1907, commanding rents of $2,200 to $3,000 a month for places that people would walk away from in other cities, but young people were happy to have it. They're just having their finances gutted to enjoy the San Francisco experience. Well, all that is threatened with change now as we move ahead, and we see the legs blown out from under the tech sector. There's going to be changes coming. There's going to be pressure on real estate. There's going to be deflated values, not only in the energy sector that we talked about before, but now spreading over to tech and real estate. It's interesting, all these, when you look at the energy sector and you see what 1 year of really bad damage that accelerated in the last 4 months can do. You look at a company like Chesapeake Energy, it was one of the huge offshore drilling experts. If you wanted to drill on land, well, it wasn't rocket science, but if you wanted to drill at sea, in the ocean, boy, that's a whole new skill set, and not every company could do that type of work. But there was Chesapeake Energy's a leader in that. That stock was up to the 30s, 40s, $50 a share during the go-go days, consuming pipe stock, everything out of the mills for production. And today it sits a little over $1 a share and just consumed with debt and just waiting for a schedule to come on to bankruptcy. This is a preview of coming attractions here as the ripples start to spread out from different sectors of the economy. Contrast this to December when we were at 17,000, I guess it was 17,700 on the Dow, and the Christmas rally had come, and people were very excited, and 90% of advisors were bullish. Of course, we were out of the market at that time, being out since summertime when we got our flashing red signal. But at that time, when the market started down on its horrendous late December and January run to the downside, people scratched their heads because they couldn't figure out, in light of such a strong economy that the Fed was featuring our way, how could these stocks be tanking? And now a little bit of time goes by to February, and well, people are starting to see the results manifest themselves in the real economy with layoffs and all that. Stay tuned, as last week's update said, the central banks around the world, they have hit the panic buttons. They've done all that they can in the face of keeping interest rates low and making them lower. And now negative interest rates are probably going to be a fact. We just see the 10-year note today. I wake up and it's at 1.74%, an amazing drop, and it could go down to 1%. Who knows? In which case, everybody with a mortgage will get a break. But mortgage originations and banking business will also be one of those epicenters of pain that not only deals with difficulties of very small margins in trying to make money, plus declining demand for borrowing, plus too much cash in the institution, plus a rapidly growing cancer of bad loans that are going to be written off, not only in the energy sector, but a lot of that technology and retail sector too. It's a bad brew. It's a really bad brew. So, well, all of this takes a major adjustment, and here we sit today. So, until we, will there be a decent rally? Sure, somewhere in here. I rode a little mini rally the week before last into the beginning of last week. But if you're going counter trend here, you got to be so careful, because you can wake up in the morning and you're already down 400 points or something on the open and trap. So it's really, really difficult. That's why I always say, pick a direction and stick with it. Right now we're short the market, and for those of you, not short, but out of the market, and for those of you who have been out since last summer, and there's a few that watch on here, you got to be feeling pretty good about your positions now. So figure it this way too, when and if we get a decent rally in this market, there'll be a lot of people that want to use that opportunity also to hit the exits. So it'll probably be a long time before we ever see 18,400 again on the Dow. Bears repeating that in December of 1996, the Nikkei Dow Jones Index in Japan was just a shade under 40,000. And today we sit at about, after how many years? 20, 25 years, 30 years, we sit 20 years later at a point less than half of that value from 1996. Maybe it was 1994. I can't quite recall, but it shows you how long things can be bad, and how when an economy can't be repaired just by low interest rates, that the panic buttons are hit, and then here we sit today. So beware, things can go for a long time when the trend sets itself in motion. Thanks for watching, everyone, and we'll see you next week. I think it's Valentine's Day next Sunday. Thanks, everybody.